Hello, folks. Brandon Chapman with you today. It's a Monday video for TheoTrade. It is a selling day on March 3rd, first trading day of March. We get into the next month from February. Friday, we saw a bit of a rally in the market after the sell-off on Thursday. You think all as well as we're aiming higher just off the open, and then things get ugly. Go to a 1 day, 1 minute chart here. You'll see it began to break, and then all of a sudden we started to take out 5,900. And we pushed towards 58.20 on the ES futures. The key level Don was looking at was 59.11. You can see how we're hovering there before breaking. And at that point, the VIX began to run, as you'll see, as we began to run towards about 24.5 or close to that. And we're just kind of backing off a little bit as we're heading into the close here. This is one of those points where, you might just say, well, my goodness, what's the next phase? Are we going to fall into the abyss? This is a point where people might panic. And the reality is, a lot of the run in the market this last little bit was about retail investors getting into the stock market. It was about retail investors taking on excessive margin, expanding credit on a national scale. And right now we may be seeing that credit reversing as retail investors may be pulling out. And we already know that last week, again, a lot of the institutional side of the market was getting short and selling. And so now we're just waiting to see what's the next stage. It's one of those things where, if you have not prepared for the sell-off, that's a problem, right? Knowing when to hold them and knowing when to fold them, right? We're going back to Kenny Rogers here. When should you have considered to fold them? Well, you fold into strength. Otherwise, you're selling into weakness. And the reality is it's about having a systematic approach that says, how do I know when to sell into strength? How do I know when to hedge? Well, there was a very significant signal back on February 14th. And then on the 18th, we walked through why the volatility markets were pricing in a 5 to 10% correction in the S&P 500, why you should consider taking profits, in particular on your high beta, meme-oriented stocks, and why you might consider hedging. We talked about two hedgings, the atomic hedge, buying puts, selling call verticals. And then we walked through a VIX volatility spread, looking for the VIX to push towards 20. Well, guess what? We already had that last week. There's the closing bell, folks. And then we kind of moved it out of bounds, right? We moved it back up to 25, 29 in case we see something wild. And is today something wild? I wouldn't necessarily call it wild. We're down 1.74%. It's not like we're down 3 or 4%. The VIX went up about 3 points today. It's not like we went up 10 or we go back here to, for example, December 18th, where the VIX went from 15 and spiked up to 27. It's not like we're having something like that. As we look at the advanced decline line right now, right? We're going to look at DECN, declining versus advancing issues. And we're seeing, okay, well, how many stocks are down versus up on the New York Stock Exchange? And you'll see 2.3 here. That's not exactly crazy territory. Only 2.3 stocks are down versus up. A typical threshold to see real capitulation and correlated selling is 9 to 10. So while people may be looking at today because they're holding stocks that are very highly volatile, let's look at MSTO. Let's look at up volume and down volume. So DVol, we're looking at down volume first on the ratio because we're down today. And then we got UVol. What's the ratio of down volume and up volume? It's only 3.5 times. Only 3.5 times more volume on down stocks than up stocks on the New York Stock Exchange. I showed a statistic in Friday in some of my masterminds, my newsletters. MSTR, for example, gapped up today. Guess what? We closed the door. Bitcoin, right? Bitcoin gapped and we closed the door. Whatever news that came out over the weekend about, a crypto reserve, folks, realize there's a lot of leverage and paper in this market. This is paper Bitcoin. It's not real Bitcoin. MSTR. Well, if Bitcoin all of a sudden drops a lot, what are they going to do? Right? They borrowed money, bought a lot of Bitcoin. So again, we look at these stocks reversing today, and we're starting to see the potential of risk to the downside. Even stocks like Oxy getting slammed today. Why? OPEC coming out and saying, hey, we're going to start to raise production in April. Maybe the fact is they've been cheating already on their agreement. And this is when oil prices start to soften and the outlook and demand story starts to kind of fade away, all of a sudden we're in a position where they begin to cheat and oil supplies start to go up. We look at product depth today, for example, in forward/CL. We'll come back to VX there in a second. But we're still in backwardation. But look at this out here as we get out towards February. This is next year. We're still in backwardation, though. But are we flattening out a little bit? Let's go to curves here. And I'm going to add back some other curves here, seeing if the curve is flattening out. And we'll have to say, no, it's not. So despite today's news, we're actually seeing this curve get steeper in backwardation. And yet we're seeing selling in oil stocks. Again, we're seeing down 2%. We're seeing an outsized bearish presence, all because of what? The futures market may run into a brick wall, but stocks begin pricing in maybe 6 to 9 months in advance. So if Oxy starts to break support, essentially what we're saying is, my goodness, we may be looking at much lower oil prices and demand in the future. Well, what does that mean for the bond market? All of a sudden, we're starting to see diminishing inflation expectations. We're seeing TLTs near the high of the session. Is this a capital rotation? In my newsletter today, First Mover Market Advantage, I talked about 3 charts to look at. We're looking at S&P versus utilities, S&P versus gold. We're looking at cyclicals versus staples. This tells the story right here. Don't forget XLP. Okay, look at the breakdown in this yellow line. What this is signaling is major rotation into what? Staples against cyclicals. Look at high beta names today. Huge breakdown, but look what's happened over the last week. Major breakdown in high beta names. Okay, we are seeing a very real rotation. Utilities up today, and yet the S&P is down 1.74%. I talked about those 3 charts today and looking at the possibility of TLT. And if the Fed begins to cut rates and they go to ZERP, what's the potential here? ZERP back here in 2020 got us to 170. Is that a decent reward to risk? In a previous edition, I talked about buying an upside call vertical because the pricing's excellent because of the skew. So the idea is you're trying to make significant decisions about your portfolio, but hopefully you walked into the current sell-off already hedged. So on our session chat room, I talked about the idea today is, hey, we already rolled those puts once. Let's go to the analyze tab. I'll kind of show you what we did. Go back to SPY here. Try this again. SPY. Okay, there we go. So what do we do? Originally, we bought the 599 puts. We sold call spreads to finance it. We then rolled the put from 599 to 582. We bought back the call spread for 60 cents. Now we're sitting on a 582 put with the S&P at 583.84. Well, guess what? Tomorrow we start to break through 582. We roll it again, and that was about $1,000 we took out of that roll previously. Okay, when we broke below 599. We're looking for the exact same number or nut to hit. And again, you could keep it in the 21st of March. You could roll it out to April. You're going to get less of a roll in April. But this is the type of stuff you want to have right now, right? You want to have that 582 put because why? It's removing the downside risk in the market. It's limiting the potential loss you can receive pending what? Pending the market finding a bottom. Is there any indication today the market's finding the bottom? Well, you look right here. We're down $10 on the SPY. What's the ATR right now? So we'll kind of come here to edit studies. We'll add in the ATR study and say, okay, the ATR right now is about 1560. Guess what's happened? Over the course of the last, let's go to not a weekly basis. We're going to go daily. That seemed really, really high. It's about $8. Notice how this is sharply increasing. The more volatility we experience, the more we have to get. Today is enough of a down move to mark a near-term bottom, the S&P. If we look at the VIX, did the VIX spike above the 2 ATR calendar channel? We kind of faded there towards the close, which isn't good, by the way. If we're really looking for the market to find a bottom, did we close above the 2 ATR calendar channel? Yes, we did. Did the VIX end up in backwardation? Meaning, did the VIX curve go from a rising slope to a falling slope? And I'll take off these other curves here. We'll just look here. The answer is yes. 20, and the next contract's pricing 2017. We're in a little bit of backwardation here. This could get steeper, by the way. If we continue to sell off, we might see this push out much longer. Okay? The VIX 3M, we're looking at the ratio of 3-month to 1-month volatility. Did we break below 1, meaning the 3-month volatility is now below 30-day volatility? The answer is yes, right? In essence, the 3-month VIX is 97.3% of the VIX. So did we have a signal of a potential near-term bottom in the next couple of days? Yes, we did. And you might take this to say, look, you're looking for an opportunity to go long. And you're ready to do that because why? You're hedged, right? You have a chance. You took profits on the pop and the VIX. You have another one in there in case we keep going. You've got a hedge of 582 on the SPY in case we keep selling off. And those ratios are, by the way, are based on the idea that you have about 100,000 in the SPY. 165 beta-weighted deltas. You are ready for almost anything. But here's the problem, right? That signal is generally a bottom if we're talking about a 5 to 10% correction. Well, guess what? How far into this sell-off are we right now? Click on the high, go down to the low today. Let me just bring this down a little bit. How for 5.44%? We're already 5% into it, right? We're at the lower end of the upper end of our 5 to 10% threshold. And the volatility markets are saying, hey, we're expecting a little bit of a drop in volatility in the next 30 days, generally commensurate with the near-term market bottom. But again, going back to this, $DECN plus $ADVN, we're only seeing about 2.3 times more selling stocks down on the New York Stock Exchange versus advancing. A 9 to 10 threshold is generally indicating a major market bottom, like we got in August 2nd, for example, and like we got on December 18th. We're not there yet. Don calls it correlation, right? Correlated selling. We have not gotten that for the market generally. What about volume? $DVOL and UVOL are 3.5 times more volume on down stocks and up stocks on the New York Stock Exchange. Again, a 9 to 10 is your 90% day, something we hit back on December 18th and August 2nd. What this tells us is the fact that, look, we are seeing a major change, right? By virtue of rotation, capital rotation in the market. We're seeing it towards defensive sectors, staples, and utilities, and gold, by the way, up 1.3%. Silver up today, 1.5%. What about gold stocks? Let's look at GDX here. Gold stocks basically flat. So we're seeing that gold is outperforming the market, which suggests the weakness in the market's even greater as the dollar's slipping today, as money's going towards gold. So the idea is we're looking for opportunities. Where are those opportunities? I sent something out last week based on an option pulse on KHC, for example. Kraft Heinz up 1.99% today. We're looking at 33, possibly 36 if we keep stretching. We're looking at defensive parts of the market. What about Southern today? Breaking the 61% en route to 94. But here's the issue. Yes, if we continue to sell tomorrow, if people find themselves in trouble today because of margin and excessive leverage, they may have to sell stuff that they're profitable in. Yes, that may mean we have to experience some degree of correlation. But the reality is, if you're getting stopped out right now, if over the last week you're getting stopped out and that's the way you're raising cash, that's a hard dynamic. You're going to be antsy. You're going to be very reticent to try to get back in, but you've got to find that opportunity. But do you step into the high-flying meme stocks, high volatility, massive short interest, no cash flows? Or do you do you step back into the stuff that may have some degree of resistance to the selling pressure that we're seeing because of their defensive nature that might actually benefit by a further drop in interest rates, as we're seeing that the Fed expectations of a rate cut are shifting more towards a rate cut this year by December. The Atlanta Fed, they're pointing to the fact we're looking at going from -1.5 now over 2% decline in GDP. They're cutting expectations for GDP right now as we're cutting spending. And we're talking tariffs, we're talking war, lots of potential headwinds. You may like the idea we're kind of reordering the financial universe right now. And I'm with you in a lot of respects, but it doesn't mean we're not going to experience some near-term pain. And it might be the Trump administration may welcome the pain right now. They just took office a month ago and realizing things are not all they're cracked up to be, as we can definitely see by virtue of the Doge findings, whether or not that's going to amount to anything really significant. But we definitely know there's a lot of waste going on, and the government was spending money excessively to make the G in GDP, government spending, part of it, to really emphasize the growth. Right now we're cutting. What else is left? Any sort of reorienting of the financial economy from a debt-based economy we've been in for decades to a savings and investment-based economy, even if you do everything right, could be a little bit of pain or a lot of pain for 2 to 3 years. It takes time. If you're going from an import-based economy, debt-based economy, to a savings, investment, and a production economy, it takes years. So the risks right now say, look, yes, is there a capital rotation event happening? Absolutely, it's happening. The question is for how long, but all of the stuff happening right now, it's a consequence not of decisions being made today, but a consequence of decisions that have been made going back to what, 1971? Right? Going back to what, maybe the 80s, Plaza Accord, other scenarios where we decided to print money and go the debt route. That's what we're trying to reorder right now. That's what we're dealing with, is decades of excess and debt and a record high debt and deficits by the federal government. Any deviation from that will create short-term pain, but long-term gain might be possible. It's going to take time. So no matter how optimistic you are or pessimistic about the administration, you can be right as long as you realize or acknowledge the significant risk to the downside in the market. That may mean that interest rates come down as our growth expectations dwindle, as the Fed may cut rates more, and we may see that continue to shift. And that's something that did boost the market on Friday. Okay? So again, we're going to watch for opportunities to roll the put as a hedge. We're going to watch for opportunities. I was putting messages in chat today. If we can get up to 28 to 30, you may want to take out that VIX spread that we got on a 25.29 that we rolled from 16.20 to 25.29. If we get up here tomorrow, you may look to close it out. But if you realize this was a free trade and you want to leave a runner, a $4 spread, you say, look, I'm shooting for $2. Okay? You could say that as well. You can shoot for the moon here. We have no risk left in it. We have guaranteed profits because we rolled it for credit that paid for what the spread that was on for 29 cents at the 25 and 29. And if we get to 30, you can roll it again, roll it out further and keep rolling it. Again, are we going to get something like this? We've had several bumps in volatility. There's been some put option buying. What we're missing right now is correlated selling. Everything else really seems to be there for a near-term bottom, and we might catch a bounce here for a couple of days. But realize that the rotation event that we've experienced may only allow this thing to rally for a little bit before we start to see rollover. And 5,900 on the SPX, 5,911 on the S futures, those are your levels, folks. If we're below that, again, we might continue to see a bearish bias. If we start to break above those levels, we might start to see more buying. But even today, did not hold up with the weight of news and other sentiment driving the market lower. There's fear, there's rotation. This may continue for possibly a 10 to 20%. So thus, as we talked about the atomic hedge, I've continued to stress, keep it on and keep rolling it. We don't know what's going on. We want to mitigate the risk. We want to be there when the market rallies. That's why we're rolling. If you want to keep it on, let it continue pushing the money. This is what will happen, right? You're taking away your downside, but you're also removing your upside when the market bottoms. And it's all a matter of just deciding, when do you want to roll down or close? Right now, it's paid for. Why not just keep rolling it down as long as we're continue to see the selling? And again, pushing towards maybe 10% or lower, king off NVIDIA and other stocks right now. Again, this is kind of the management of the hedges we got going on. But again, we're watching right now. Be prepared for more selling. Is it time to sell stuff? If you haven't taken profits, the reality is even hedging does not hedge a bear market, it hedges a correction. You cannot hedge a long stock portfolio indefinitely. We're only mitigating the near-term risk in order to what? To take profits, as we talked about here, mitigating the downside, and then we have a choice. We can reallocate our portfolios to stuff that's more defensive in nature. We can continue to take profits and raise cash. But again, right now, it's important that we've had those hedges on during the sell-off because, again, we might see another 10% move, 5% move. We might see 550 down here. Those would be reasonable expectations in the coming weeks. But we could easily see a short-term bounce here and may give you an opportunity to come up for air and possibly put on another hedge or start to take on some bearish trades. Well, folks, all we got today. We'll catch you back next week on the video. You have a great one. Thank you.